Thanks, guys. We'll get started. So, for those who aren't aware, I'm Joshua Barker, founder of Barker Wealth, and I'm joined today by the team at LVP to present their Granite Fund. I think this is a really good opportunity for our clients and our broader network. So, yeah, we've got a little bit of time on this one, so we wanted to jump on here and provide a little bit more context directly from the fund manager. So I'm here today with Richard and Ollie from LVP. Guys, thanks for joining.
Thanks, Josh.
Perfect. Thanks, Josh.
Ollie, do you want to just give us a little bit of information about LVP something that investors should be aware of about the business?
Yeah, absolutely. And thanks everyone for joining. Let me just roll forward. Perfect. So as Josh mentioned, my name's Ollie Freeman and I lead the distribution efforts at LVP, and I'm joined by Richard Chapman, who is one of the investment directors and portfolio manager for Granite, who I'll pass over to shortly. But firstly, a quick brief introduction on LVP. And for those who haven't come across us before, LVP is a Sydney-based private markets manager. We were founded in 2012 and have roughly $1.8 billion of funds under management. Our clients range from some of the largest institutions in Australia, from super funds, and then some global pension funds as well. And then we have 10% of our client base that's family offices. And LVP's core is investing across private equity, impact and growth, and real assets. So we have a bunch of commingled funds, but then also some separately managed mandates with some of our larger clients. So the institutional DNA of LVP is important context for today's conversation. It shapes how we think about portfolio construction and how we also think about the risk of assets and how we shape funds like Granite for our wholesale high net worth investors. So that brings us to Granite. Today we'll walk through our yielding alternatives evergreen fund. I'll pass to Richard shortly to discuss the investment thesis behind the fund, how the portfolio has been constructed around the seed assets, and why we think the fund offers something genuinely different to a lot of other opportunities in the market. So Richard, I'll pass over to you.
Yep, thanks, Ollie, and hi everyone. My name is Richard Chapman, the portfolio manager for Granite. I've been in the private market space for over 20 years, and in terms of relevant experience, spent over 10 of them managing an evergreen vehicle that was listed on the London Stock Exchange as one of now the FTSE 250 vehicles, but particularly relevant in terms of experience. As I used to manage it pre, during, and post the global financial crisis. More latterly, since being Australian-based, I was head of private markets for Qantas Superannuation, where I actually built part of this seed portfolio that we're going to use for Granite. In terms of what Granite is, it's an open-end vehicle, which is predominantly real assets focused. It's got the defensive characteristics, which we've got a chart which explains that in a few slides, of a real assets portfolio. So we can generate yield as well as capital gain for investors. You'll see in the second box here, we're targeting a 12 to 15% total return, which will include an annual target of a 5 to 8% yield. Now, what we believe we're offering here is a total return that matches growth vehicles, but also a yield profile that matches some of the yielding opportunities you see in both public and private markets. But in both cases on equally or more defensive bases. The seed portfolio is very attractive and gives a good uplift and returns right out of the gates. It includes an aged care platform. It includes an SDA platform, and it includes some sustainable seafood assets, again, which we'll touch on, all driven by strong social thematics. Portfolio construction, I've touched on briefly my background, but what we're creating here is a vehicle that will essentially run as fully invested. It won't be like other vehicles, which might suffer from cash drag or haven't been able to manage through cycles. We intend to offer a fully invested portfolio from the outset. And again, just touching briefly, we're a thematical investor. So whether it's our real assets or private equity focused investments, we look for strong tailwinds from a macro perspective that help drive the businesses. And we can touch on them. We've listed a few that we focus on here, like aging population, social welfare, digitization, climate change, food security, a number of which we touch on in the seed portfolio.
Yeah, I think that was one of the really appealing factors of offering this fund out to the clients. Whilst I guess the seed assets and the fund profile would be private equity, I really would put it in that real assets category because it does have such different characteristics to private equity. You've got liquidity in the fund available, high yielding assets, and backed by real assets, which are typically characteristics that are not always the case in private equity. So I think it's a really good example of the types of investments that we want to add to clients' portfolios, not only from just being a good asset in itself, but I think from the different profile that it adds to portfolios as well.
Thanks, Josh. Touching on this slide, we'll just touch on it very quickly. We've tried to compare the returns or show how we've constructed the returns and what it offers. So you can see here with Project Granite, the dark blue bar, it's offering a yield level that will match your private credit vehicles, but over and above, it also generates capital gain. So that will compete with the growth products on the market as well. And what we'll show, if we can actually jump to the next page fairly quickly, I can talk through how we do this. And really, this may look complicated at first, but let me simplify it for people. It's how we view the toolkit of what you can do in the private market space. We think it's quite simple when you pare it back. If you look at the different oblongs, private equity is just investing in corporates like you do on the stock exchange, but privately. Real estate is just building, infrastructure, and natural capital, your natural capital, agriculture, timberland type assets. Within all of these, they sometimes use different terminology to complicate things, but they're not really that different. They might use greenfield at one end, which is the higher risk end, higher return end. They might use brownfield or core at the other end, which is more your established and developed assets that are cash flow generative. Once you understand these things are actually quite simple, you can combine them to do different things. So this chart, you can just look at the axes individually and work out what we're doing here. So at the top right end, if you look in the corporates bucket, the private equity one, you'll have something like venture. So that has very little cash flows, but can generate a very high absolute return. And typically that is a capital-based return. At the other end of the spectrum, you might have your core or your brownfield developed assets. They're very cash flow generative. They might even be underpinned by government supported cash flows. And what you generate there is largely income driven, and it can also be used to create other portfolio diversifying characteristics like the inflation hedges. But what we do with Granite, and you can see the dotted line, is we're focused on the real assets. We can touch on private equity if we wanted to generate excess capital gain or extra capital gain. When you see the seed assets, they're real assets focused. We aren't taking the greenfield risk. We've very much got kind of core plus opportunistic through to core, largely developed, de-risked, but still able to generate between that inflection point of income and capital gain, the 5% income we're targeting, as well as the 12 to 15% total return. Josh, any questions on that to start with before I delve into the actual seed portfolio?
Yeah, I think that all sounds great. Sort of that 6 to 8% yield, and then that total return of around that 14 to 16%, I think is a really good return, but I think it's more important about the way that it's achieved. And I think this fund in particular, backed by the real assets, strong cash flows, is what makes that that stable nature, yeah, quite achievable, but also, really strong from a risk to reward point of view. Yeah, so, really interesting sort of return profile and risk profile. How exactly is the fund looking to achieve that in terms of its assets?
Nice. We jump onto the seed portfolio. Thanks, Ollie. What we have here is a seed portfolio that actually built when I was head of private markets at Qantas Super. Qantas Super, for those of you that may or may not be aware, was subject to industry consolidation. So it was a top-performing superannuation fund at the time. It got taken over by one of the big industry funds. It was a multi-strategy private markets portfolio. The portfolio landed in a private equity asset class bucket. Superannuation funds are subject to your future, your super benchmarking, so they can't really hold assets that don't match the asset class bucket. So it's provided us an opportunity to transact on the non-private equity assets in that portfolio. Those assets I'm very familiar with and very high conviction of. At the time of making the investments, they were taken with development and execution risk built in. Roll forward roughly 3 years, and those assets are now de-risked. We've struck a transaction whereby we can buy down these assets at the June 2025 NAV, so last June's NAV. Roll forward to the launch of Granite. These investments have continued to perform as they've essentially said on the tin. Talking through them, what you've got there, and I'll talk through them actually in the order we're likely to buy down the assets, because we can take them down in the order we choose and in the amounts we choose. First, we'll be looking at the aged care asset. That was originally invested in 2022 as a concept. It's since undertaken various M&A and development transactions and opportunities. Roll forward to today, and having made the blindfold investments, now consists of 18 residences, 96% occupancy, and of that occupancy, it's supported by government-supported cash flows, so the ANAC scheme to be precise. With the development and completion of a number of these residences, you've had material uplifts in valuation to the tune of, you've got roughly 830 million's value of the residences, less the RADs that tenants can buy. And with a very cash generative profile, generating roughly 8 million a quarter, it's paid down a lot of its senior debt. Now, it's actually a not-for-profit structure. The investment that Granite has undertaken, and I should have touched on before, it can do equity and preferred equity investments. This is not a private credit strategy. What we mean by preferred equity is that it's the area in between, which can include various alternative structures, from notes to convertible instruments to royalties and leases. It's enables you to capture some of the upside. It also helps you build in some defensive characteristics. Now, the aged care instrument is a social note. So it's priced as a 15-year instrument, generating 14% coupon on the principal, and has a make-whole provision if it ever gets refinanced early. Roll forward to today, that's a very attractive profile, generating 14% on the principal with the upside of the make-whole provision, given it's now de-risked and largely fully occupied. So that'll be the first asset we put into Granite. It's obviously been performing in line or above expectations from a trading and operating perspective. So we'll target that one first. So a very attractive platform investment, very low risk, given it's got lots of real asset, i.e. buildings and land value underpinning it, albeit the cash flows are primarily a product of the government-supported occupancy levels. The seafood sustainable seafood opportunity is a very interesting one. It's quite idiosyncratic in nature. It's a leasing opportunity. What we buy is what are called quota or ITQs, if I slip into acronyms, for seafood, wild caught seafood across Australia. Now is actually a large market. Some people haven't come across it. It's not typically an opportunity institutions pursue, but it is a big market. So Australia is very good at managing the sustainability of its wild caught seafood. It issues ITQs or quota, and then regulates how much commercial catch is allowed in any given year based on sustainability levels. We have not taken on any fishing or operational risk doing this, but what we're doing is we're buying the quota and we lease it back to fishermen. We try and help and support local job opportunities, and we help an intergenerational shift. What we invest from a thematics perspective is a kind of a supply constrained but growing demand thematic. So wild caught seafood and seafood as a protein is in very high demand if you think of rise of middle class or aspirational thematics. Whilst if you think of on the supply side, it's government regulated and it's typically capped or declining. So what you see is year-on-year growth in not only the value of the ITQs, but also the yield profile of the ITQs. And it's a big market, as I mentioned. There are over 40 different ITQs for all the different seafood species in Australia. We only target sustainable and recovering species and high-value species. And you've got over 15 years worth of data of the amount of it we own. 170 odd millions worth of ITQs in the context of what's actually a 22 billion EV market. So it is a large market. It is liquid. It is backed by the seafood. So you've got the real asset backing, and you've got the strong cash flow backing as well. So a very interesting opportunity. Made even more so from a seed asset portfolio perspective, because you don't really see any, given the supply demand characteristics, any disruption in the values or the yields other than during COVID, where there was a blip. And that's when this portfolio was built up. The values are locked in at 30th June 2025. So it's an attractive seed opportunity. SDA is the third asset that will blend in from a seed portfolio. SDA is disability accommodation, specialist disability accommodation. Again, we have used a note structure. We've got different instruments ranging from 12 to 14 to 16% on the notes. This portfolio is part of a broader LVP managed portfolio, developing 68 properties, of which we have about 20 left to build, 20 odd we've completed in the last 12 months, and 20 now occupied. We do benefit from government-supported cash flows. These are the NDIS ones. I would stress just briefly that NDIS has been in news, but we focus on high acuity SDA, which is still forecast to grow despite some of what you read in the press. So we're targeting high physical support and robust residences or villas or houses to help that space. So that's the seed portfolio. Very attractive. Maybe very quickly, Ollie, just jump onto the next page, which kind of highlights. Oh, sorry, the next one after that, 9, which highlights those defensive characteristics. So you've got the diversification across number of properties, buildings, land, seafood, and you've got these strong cash flow backing. So you've got real asset cash flow backing and strong return profiles despite this, or as a product of this. So it's very, very good risk-adjusted return profile for a seed portfolio.
Yeah, I think one thing worth noting on these assets is not only are they, quite defensive and the return profile really strong, but these are well-established assets. That's why Richard can talk about them so well and intimately on the past performances. He was managing these at Qantas Super, and these three assets are currently operational. They're currently running. They're currently bringing in cash flows. So not by any means a new asset to the team. And something that has got that really proven track record and return, and I don't think it's too variability about how that's going to perform over the future, especially when you've got really good eyes over what they're currently doing and what they've done in the past as well.
No, exactly, Josh. And it's particularly in this market when you're seeing quite a lot of volatility. As you say, these assets are very well established. You've got thematics like aging population, you've got asset value backing, you've got government supported cash flows. You're not going to be exposed to, for example, a private equity portfolio, which might be heavily exposed to software, for example. These are doing the returns already that they say on the tin. And with launch coming over the next month or two, you've benefited from the transaction structure as well, whereby they've been running, like you see here from a performance perspective, since 30th of June 2025, where the price is locked in. So good, stable, straight line return profile, as well as a benefit from transaction structuring.
And just to really highlight that point from an investor point of view, so put simply, you've agreed to purchase these assets on the valuation of around 10 months ago. So what does that mean for the fund as it sort of gets started?
So that's absolutely correct, Josh. That's how that structure works. So we've agreed the price to 30th of June 2025. It'll be about 10 months since launch. Based on our anticipated taking down of the portfolio, or taking down order of the portfolio, we estimate it should launch with roughly 15% uplift on day one.
Yeah, wow, that's definitely attractive. There's not too many investments you can sort of get involved in and have a high level of certainty that you're going to be up on it at all the next day, let alone up a decent amount of sort of double digits at the very least anyway. So yeah, really attractive. And then from investors' point of view, we're sort of looking at getting that yield coming through straight away as well. Is that right?
Yes, yeah. The portfolios, that uplift is largely driven by cash that the portfolio has been generating over that period of time. So we're paying, the target is the 5 to 8%. We anticipate paying near the upper end, and we'll pay from the first period will probably pay in October. We're only launching in May, June. So we'll let the cash continue to build, and we'll release the first quarterly yield payment, targeting the upper end of the annual target, obviously annualized in October.
Yeah, beautiful. And maybe we can move on to the next slide and talk about some of the key dates that we're expecting to launch the fund anyway.
Okay. Ollie, do you want to take this one?
Yeah, sure. So these are the key terms for the fund. So, as we've kind of run through, we've got an investment objective, investment strategy, and around the seed portfolio. With regard to the structure, and as mentioned, it is an open-ended semi-liquid vehicle. So what that means is it's going to be monthly applications, monthly redemptions, quarterly distributions. There is an initial 2-year lockup period. And so this is just to allow the portfolio to get set. The seed transaction also allows us to buy down these assets with another 12-month look back as well. So we've priced off June 30, 2025. when June 30, 2026 rolls around, the transaction resets, then we have another 12 months to buy down. So we anticipate almost a very decent underwritten return for the following year, but the initial lockup period just lets us get to a steady state. Eligible investor wise, this is offered under an IM, so it is wholesale only. Investors are eligible. Minimum investment amounts, we accept applications directly or via platforms. We've got an agreement with Barker Wealth that we've waived the direct investor application amount. So very flexible and really enjoy working with advisors like Josh. So we've agreed that. And then we've got the management and performance fee, which is noted there at 1.5% management fee, and then a performance fee 12.5% over an 8% hurdle. And so that means that we don't get paid until we hit 8% per annum minimum with regard to the hurdle.
And in terms of the fund getting started and launching on that date, maybe worth just highlighting, we touched on it a little bit, but really just sort of highlighting how the assets and which particular order those assets are going to come into the LVP Granite Fund.
Yeah, the first one will be the aged care. We're essentially taking it down in the most de-risked and most advanced return. So we're balancing the risk-adjusted return again. Aged care is fully developed, so we'll take that down first. Then you'll likely see seafood and SDA blended in thereafter.
So the aged care profile was looking at around a 13% target yield. Is that right?
Yes. Yeah, that's the yield payment of around that, based on the 30th June purchase price, not factoring in potential upside from the benefit of the make-whole provision. That's getting into the granular detail.
Yeah, I think that's important that, the first seed asset is probably the most conservative and the one paying the highest yield. So, we anticipate that first couple of years of the fund will perform, very stable to what's been targeted anyway, given a lot of it's coming from yield of, real assets backed. So, no, that's really promising. Guys, feel free to add some questions to the Q&A box. One question that we have had come in from someone that wasn't able to join us was just a really simple, broad one around sort of the NDIS tightening, I guess you can call it, that's really been covered in the news, for without any specifics necessarily, but something that's been well publicized as well. So how does that risk sort of affect the portfolio, if it does at all?
It doesn't materially impact, and I know you've been sort of discussing this with the operational team as well, so feel free to chip in. But there's not material risk to our portfolio because of the high acuity end of where we're targeting. You'll see what the NDIS coverage has been typically targeting, and actually we had some interesting stats the other day. Ollie, you'll correct me if I'm wrong, but it's something like the likes of 1 in 6 boys are receiving NDIS funding for the likes of ADHD. Correct me if that stat was slightly wrong, Ollie, but what we're targeting here is specialist disability accommodation for high physical support and robust, which is essentially mental health care patients. They represent 1 to 2% of the current NDIS spend, and recent research shows that high acuity end is forecast to continue growing at roughly 8% per annum. So it shouldn't impact the type of disability patients or tenants we're looking to provide accommodation for.
Yeah, it's probably also worth pointing out around the NDIS and the difference between the disability accommodation as well, is that the SDA part of the NDIS is actually, the eligibility is assessed with an extreme functional impairment test rather than just straight through the NDIS. And so it's actually not affected by the broader eligibility changes which have been flagged in the minister's speech. Obviously, there's more news coming to light, but as Richard mentioned, given that we are targeting the most vulnerable on the NDIS, the government are looking to trim the edges rather than the core, which is who we're representing. We're providing housing for people that kind of wouldn't survive on their own. They have 24/7 nurses, and their level of care is mandated to be very high. And so the area we're targeting, we actually don't envisage any reduction in funding. It's actually growing in funding, and it's a very small percentage of people on the NDIS are actually eligible for the services we provide as well. So it's not an area that we think there's going to be much change. In saying that, though, and given our flexible transaction structure, we're able to see how these changes materialize and then select assets based on that too. So we have the privilege to kind of wait and see how these changes flow through before having to take down these assets, and then we can focus on the ones that we know are performing really strongly and in more of a de-risk space.
Yeah, great. Well, thank you so much, Richard and Ollie, for joining us today. We look forward to keeping investors updated on the progress of the fund and how it's tracking along. It's really an exciting story to be a part of, and one that we're going to work with for the foreseeable future. So yeah, thanks for making the time, guys. Really appreciate it, and we'll sort of certainly be in touch.
Thanks, Josh. Thanks, everyone.
Perfect. Thank you very much.
Thanks. Bye.